Imagine finding out the bank handling your retirement has been secretly pocketing a cut of your money every single year. You never even saw the charge.
Yeah, it happens all the time, honestly. It's incredibly common.
Right. So today we are doing a deep dive into a fascinating January 2026 research report from pvtIQ on Endowus. They are this Asian wealth tech platform that just hit 10 billion US dollars in client assets by, well, doing the exact opposite of that hidden fee model.
It is a massive milestone. I mean, 10 billion is no joke. Our mission today is to figure out how they built that empire by completely upending traditional banking fees and, look at the really intense competitive challenges they're facing next.
Okay, let's unpack this, because the report highlights their radical fee-only fiduciary model. Basically, they rebate 100% of trailer commissions back to the client. But for those of us not deep in wealth management, what exactly is a trailer commission?
So think of it as like a hidden recurring kickback. A fund manager pays your broker or platform a percentage every year just for keeping your money in their specific fund.
Oh, well.
Yeah, the client rarely sees it on a statement, but it quietly eats into your returns over time.
So it's kind of like paying for a premium cable package, right?
Yeah.
But you don't realize the network is actually paying your cable provider to just force feed you channels you don't even want.
Exactly. That is a perfect analogy.
And Endowus is essentially saying, look, we're Netflix. One transparent, flat rate subscription, and absolutely no backroom kickbacks.
Right. And what's fascinating here is how that transparency actually acts as a behavioral defense. Like when clients fundamentally trust the platform, they don't panic.
They don't just sell everything when the market drops.
Exactly. But you might wonder, if they are giving all those commissions back, how do they build a $10 billion platform?
Yeah, where is the sticky money coming from?
It's public pension funds. So Endowus was actually the first digital advisor to let Singaporeans invest their dormant Central Provident Fund savings, their CPF.
Wait, really? The government pension system?
Yeah. Yep. Instead of fighting for, day traders who just hop between apps, they locked in this highly predictable, really long-duration retirement money.
That is so smart, because once you prove you can securely handle people's life savings, you earn the ultimate currency, which is trust. And looking at the proprietary metrics from pvtIQ, that trust is heavily quantified.
Oh, totally. The numbers are huge.
Yeah, they have a stellar pvtIQ Smart Score of 4.5 out of 5. But the metric that really jumped out at me was their pvtIQ Alt Data Score. It features a massive 4.7 out of 5 in product affinity.
Which is driven by their exceptional app ratings. And that product affinity metric is crucial because it means people are actually engaging with the platform for education and wealth planning. They aren't just, obsessively logging in to check their balance when the market crashes.
Right, which prevents the panic selling you mentioned earlier. The report even noted they saw net inflows during recent market turbulence.
Exactly. Trust literally equals stability. And armed with that stability and a recent $70 million US funding round, they are expanding upmarket. They are targeting what the report calls the sandwiched affluent demographic.
Sandwiched affluent. So that's the $1 to $10 million range in assets, right?
Yes, because this group is sort of stuck. They are way too wealthy for basic retail trading apps, but they get totally ignored by bespoke global private banks.
Because those private banks want, what, 25 million minimums?
Pretty much. So Endowus is stepping into that massive underserved middle ground. They act as this crucial bridge by offering them institutional-grade private equity from absolute giants like Carlyle.
That sounds like a perfect strategy.
Yeah.
But hitting 10 billion and scoring high doesn't mean they're invincible, right? I mean, their original competitive fortress has to be under siege by now.
Oh, it absolutely is. The early moat is basically evaporating. A rival platform called AutoWealth actually just became the second approved digital advisor for that CTF scheme.
Oh, wow. So the exclusivity is completely gone.
Yeah. Poof, gone. They are replicating that exact same 100% fee rebate model. Plus, if you look at the cost of growth, it's getting heavy. The report shows that their aggressive regional expansion and heavy tech spending led to widening losses.
I think I saw that. They burned through, what, 26.7 million Singapore dollars in the 2022 financial year?
Yeah, 26.7 million. So the first mover advantage is gone, and now it is an incredibly expensive execution game to stay ahead.
So what does this all mean for you listening? I mean, think about your own retirement or investment accounts. How transparent are the fees you're actually paying?
It is absolutely worth checking. You really don't want to be stuck in that shady cable bundle with hidden kickbacks when cleaner models exist.
Definitely.
Yeah.
And here's a final provocative thought to mull over today. As platforms like Endowus increasingly integrate artificial intelligence to scale up these really complex advisory services, will the cost of bespoke, highly personalized financial advice eventually be driven down to absolute zero?
That is the billion-dollar question right there.
It really is. The old cable bundle of finance is already dying. But AI might just rewrite the entire subscription model entirely.